Thank you for watching this preview video at xm.com. We'll be discussing expectations for the third quarter earnings season starting on Friday and the outlook for stocks and the U.S. economy. I'm Maria Vachurdes, and joining me is junior investment analyst Stefanos Economidis. So Stefanos, we saw stock markets pulling back in the third quarter. What were the reasons behind this correction?
Hello, Maria. You are right. We indeed saw a stock market correction in the third quarter, which seems to be fading, though. The main reason behind it, of course, was what happened in the bond markets, with Treasury yields spiking higher after the Fed restated in all tones that interest rates are expected to remain high for a longer period. Now, we all know that elevated yields are negative for stocks in many ways. They translate into higher borrowing costs and make credit more expensive. And they also reduce the present value of the projected future cash flows for firms. Lastly, with yields in levels not seen in 15 years, bonds are starting to become an attractive investment from a risk-return perspective, because now investors can lock in a considerable risk-free return, which is something that the world has not seen in more than a decade.
So bearing all of this in mind, what should we look out for in the earnings season starting on Friday?
Well, according to analysts, we are expecting S&P 500 earnings growth to remain flat for a third consecutive quarter, despite a wave of upward revisions that started in April. From a sector perspective, communication services and consumer discretionary are anticipated to post the biggest annual earnings growth, while only 3 out of the 11 sectors are forecast to report a year-on-year decline in earnings, led of course by the energy sector. Surely we all know that the US economy remains in a better shape compared to its major peers, but that provides some optimism that earnings could surprise to the upside. Looking at some indicators, the famous Atlanta's Fed GDP Now model is currently projecting the US economy to have grown 5.1% in the third quarter, which of course could help the corporate world deliver stronger than expected results. However, given the overall dire macroeconomic backdrop, both in the US and overseas, better than expected earnings might be enough just to hold the latest stock market pullback, and they will not be what investors expect that could potentially trigger a year-end rally.
Now, assuming that earnings come out more or less in line with expectations, what are the risks moving forward?
So, as I said earlier, there is some positivity surrounding the corporate world's performance, but the third quarter also revealed some underlying risks for the US economy. We saw energy prices soaring, which could trigger a secondary inflation wave, and of course, the persistent strength in the dollar, mainly driven by rising yields, is another huge concern. Don't forget that both the Nasdaq and the S&P generate a significant part of their revenue overseas, hence stronger dollar weighs on their financial performance. From developments in the political front, fears over a government shutdown had hit consumer sentiment, while for the resolution of this matter, Congress might have to impose material spending cuts and tax increases, which will surely have a negative impact on consumer demand. At the same time, student loan repayments are scheduled to resume after a 3-year break, affecting more than 28 million borrowers by reducing, of course, their income for discretionary spending. In brief, tight fiscal conditions coupled with quantitative tightening by the Fed could be a deadly combination for stock markets moving forward.
And finally, as always, banks kick off the earnings parade. How will their numbers affect market sentiment?
You're correct, Maria. US banks kick off the earnings season on Friday, with markets forecasting lower earnings for most of them in the third quarter. elevated interest rates had been a tailwind so far for them, but the higher for longer narrative is exposing recession fears for the economy moving forward. In financials, credit card delinquencies are on the rise, bankruptcies have hit their highest level since the great financial crash, and deposits are falling as stimulus savings are fading. So now, these rising downside risks are reflected in stock prices, with the banks underperforming major bank benchmarks in 2023. And even though stock markets are currently expensive from a valuation perspective, banks trade below their historical price-to-earning averages. On the other hand, the only bright spot is the resumption of IPOs after a 2-year drought, as many tech firms are trying to capitalize on the AI mania and boost their valuations.
Stefanos, thanks so much. This was a preview video here at XM.com.